This screencast, we're going to look at Autumn 2019 question 4, focused particularly on foreign exchange risk management. So covering small bit of finance session 6 and finance session 7. So we're looking at here outline-based information provided, 3 specific areas that EPL's due diligence process should focus on and discuss the potential impact of the transaction. So watch that and there, 3 marks going for the specific areas and 3 marks going for the potential impact. So that's covered in management account or finance, usually session 4, which is mergers and acquisitions. So 6 marks there. 11 marks then underline, calculate the present value of the cash flows. So sometimes they say ignore time value of money. Here they want it all in today's money. So they tell you explicitly present value under the 2 forecast spot rates, and they're given up here in the question. So they are what we call the scenarios, and you're asked for 2 hedging techniques, money market and a currency option, and advise. So a couple of things going on there. What we'll do as well, just for tutorial purposes, is we'll do the unhedged position as well, just to look at all 3 for completeness. And then part C for 4 marks, outline 2 post-acquisition foreign exchange risks that EPL will face if it acquires Norpac, and 1 approach to manage each, no calculations. So again, you have narrative around FX risk, calculations around FX risk, and narrative around mergers and acquisitions. 21 marks in total, about 40 minutes. But half your question, or 11 marks, is calculations, 10 marks is narrative. So narrative does play an important part in Cap 2 SFME. So what we're looking at here is Euronia manufactures components for the truck and car industry, and they're looking to purchase a US vehicle component manufacturer, Norpac. Norpac generates 70% of its revenue off 1 contract. And as well as that, it's giving you detailed historical and forecast financial information. But the CFO, who is currently in negotiations, but she was unexpectedly fired last week. And what you're told is the valuation of 6750 has been put dollars to be agreed for 6 months' time. And of course, that's provisional on a successful due diligence. So they have no experience managing foreign currency transactions, and they plan to put in place a euro loan facility. Right. So borrow in euro to pay in dollars. Concerned, again, sometimes the examiner won't tell you this, other times they will. They're concerned about a strengthening appreciation in the dollar. Why is that? The stronger the dollar, the more euros it will cost you to get $6.75 million. So this is what we call a foreign exchange payable. But the key point here is it's a contingent foreign exchange payable. It's contingent on the deal going ahead, because there's no guarantee this transaction will go ahead. So you have to be careful of that when you're looking at your recommendations. And you're given information about the spot then, the discount rate, the options, and the relevant interest rates. So a very typical foreign exchange risk question that you might come across. So we'll answer them in order, but again, if you are in the exam, it may make sense to answer part A and C first. Get 10 marks under your belt, 50% of the question, before you may end up getting lost in the calculations. So be strategic in your sequencing before you go into the exam as well. So here we're at 3 specific areas for due diligence and their potential impact. Now straight away what you have to think about here is, can I do it in a tabular format? So the way I would give it kind of an outline to part A would be the issue, and you discuss it, and the potential impact. Now I'm only doing shorthand. You can have a look at the suggested solution for the more detailed narrative, but the key point is it has to be specific to the case, and try and use this tabular format to make it easier for the examiner as well. Well, one of the first issues we come across here, and we look down long, is this company generates 70% of its revenue from a single contract. So it produces components for one of the largest US manufacturers. So the key thing here is concentration risk, role of 70% contract. So that's 1 point there. You're saying there's a big issue we need to get more comfort of the single customer, right? The potential impact there is that it is only a temporary contract, no long-term relationship, and therefore you're essentially eroding nearly all the value in the company. So what you're worried about and what you need to do due diligence on is this a long-term relationship? What are the terms of the contract? Are they potentially unfavorable to the company you're buying? Or is there a long-term contract in place, and at what price? Right? So you're looking there at the potential impact of the sustainability of revenues. And in that case, it's 70% of them. So that's a huge amount. So that's your first big thing you want to get in due diligence is you want some third party to go in and make sure that's all above board. The second thing you'll want is the forecasted financial information. NORPAC have provided that. So what we're putting there is the reliability of forecasts. They are provided by the company. So of course they may be biased. So the potential impact there is they are biased and overstate future potential. So what you want to make sure is you want to do due diligence to get to see, are these realistic? Right? How do the forecasts compare to the historical, and what are the differences? And is there a justifiable reason around those forecasts? Well, that's another one, but I'm pulling it straight from the question. And finally, then an obvious one that should have jumped out is the CFO, who is one of the main lead negotiators and probably involved in doing the financial statements and involved in doing the forecasts, has been fired last week. So you want to know the CFO position. Why fired? Was there fraud going on? Was there other issues with financials? So you want to have an idea, well, why was this person fired? Because of course that's one of the leading management team in the company you're looking to buy. So was the person fired over fraud? In which case the financial statements that you have might be misstated. Or maybe the financial forecasts are misstated as well, if that person was involved in stating them. So very much specific to the facts of the case, we don't expect a long essay here. 1 mark for 3 issues, 1 mark for the potential impact. I'd expect a sentence, 1 or 2 sentences each. And don't do big long essays, just do it in tabular format. And you'll get your 6 marks. So the next one then is calculate the present value of the cash flows. Now for these type of very typical risk management questions, in this case FX, where interest rate risk are very similar as well, there's always a couple of steps you go through. The first one the examiner has actually helped you with here. What are you afraid of happening? The company here is afraid that the dollar will appreciate, that the dollar will strengthen. So think about it. Make a call. Which case here is the dollar strengthening? So the dollar is strengthening in this scenario, where €1 is now worth $1. They're at parity. So put a star there. That's the case that the company is afraid of happening. Stronger dollar means more euros to buy dollars, which means more euros to buy this company in dollars. Second step is set up your answer table. In our question here, part B, we're going to have an answer table scenario 1, scenario 2. This exchange rate is $1 is to €1. This exchange rate is $1.20 is to €1. Sometimes they'll say 10% up or down. In this case, they've actually given it to you directly. 1 is to 1, 1.2 is to 1. And what they're also giving you is the 2 hedging alternatives. I'm just putting in a third, unhedged. Money market, option. So again, the unhedged is not asked for. It's just a good one for practice more than anything. So it's good for tutorial purposes. And then I'm going to say working 1, working 2, working 3. But that's the way you should always set up your risk management questions. Same what we do with company valuations. Nice summary table and leave a couple of lines then underneath to make your conclusion at the end. Because remember, if you go back to the requirements, they do ask you advise which is preferable. So you're going to have some rationale, maybe for 2 marks, which one would choose and why. So in this case, we'll do working 1, unhedged, scenario 1, scenario 2. The euro cost, if you remain unhedged, you'll have to go into, the cost is going to be 6750 divided by 1, because $1 is €1, so 6,750 euro, or $6,750 divided by 1.2, which means only 5,625. So what we're saying here, and that should be obvious, if the dollar strengthens, which we said is scenario 1, you're going to end up paying more. You're actually going to pay 1 is to 1. Whereas if the dollar weakens, and it goes €1 strengthens, because remember, if the dollar weakens, the euro strengthens, you pay less in euros. Now, the key thing about this to watch for is, this is in 6 months' time. Because if you remain unhedged, you'll only spend the money when the actual money is due. We're asked for the present value, so you need to bring it back 6 months. So when we're asked the present value cash flows here, I'm just doing the unhedged working one as a supplement. It's not required for the full marks. And how you do that is you do 6750 divided by 1.06. So you will see here, you're told the discount rate per year is 12%, so 6 months, take half of it. So that would be 6.3 million euros. Note, in the solution, the examiner doesn't do 12% divided by 2, which is what we call the simple interest. They would do 6750 divided by 1.12 to the power of 0.5. So that's using compound interest instead. So either one is fine, but you do get a slightly different answer. But either one is fine. We're just going to use the simple interest, but you could use compound interest by putting to the power of 0.5 rather than multiplying by 0.5. And you do the same here. 56 divided by 1.06. So you can see a big swing there. If the exchange rate moves against you, it costs you about €1 million more, which is nearly 20% higher. So you slot in those two as a starting point. So clearly that really doesn't look to be a runner, because you could end up losing a lot of money and the company costing a lot more than you expected. Second one then, working two, is the money market. Now remember, the money market tries to lock in a rate today, but it uses the money markets. It borrows and deposits money. So what you have to remember now is, what are the steps? And that's where your cheat sheet comes in. You have the steps for a foreign exchange payable, which is what we have here, and a foreign exchange receivable, because they are slightly different. So in this case, we have an FX payable in 6 months. So we want exactly 6750 in a US bank account in 6 months' time, and use that to pay for the company. So figure out what you want first. That's how much we want. We want exactly $6750 million in a US bank account in 6 months' time. So therefore, we have no exchange risk. So we need to deposit 6750 divided by the deposit rate in the US. Now the deposit rate in the US, you're told here, we don't give deposit and borrowing, they just give us a single one, so it's even simplified, 1.95%. All right. So 1.0195. Now, just bear in mind here, usually in past exam questions, that's an annual interest rate. You would divide that by 2 to get the 6 month rate. The examiner said this is actually the 6 month rate directly, so that's why we're not adjusting it. But because it was a bit ambiguous compared to previous exams, if you had divided that by 2 and used it as well, that would have been fine. You get slightly different answer, but because it's a bit grey, it's not clear whether that's the annual rate for 6 months or the 6 month rate already adjusted. So there is a bit of flexibility there, so don't be too put out. That means you will need to deposit today 6750 divided by 1.0195. 6620893. And if you had done it the other way, you would have gotten 0.0195 divided by 2. So the rate would have been 0.0975. So 6750 divided by 1 plus that. So if you had gotten 6684, you get full marks as well. So either one is fine. We'll just follow the one in the solution. So that means you need to buy $6620893 today to deposit in US. So that will cost you in euros 6620893 divided by, and remember, if you're buying them today, the examiner's made it easy. They haven't given you a bid-ask rates. They've only given you a single rate, 1.0965. So the euro cost today is 6038206. Today, that means it's at its present value already. So you don't need to adjust it. That's the key point. So the way the money market works is you spend the money today to lock in 6 months' time. So think about now what happens in 6 months' time. In 6 months' time, you have this on deposit. You earn interest of 1.95%, meaning you now have 6.75 million on deposit. You hopefully, although it's not guaranteed, you hopefully have a company to buy for 6.75 and you pay it over. So we may run into trouble now in our conclusion that what happens if the deal falls through, we could have a problem. We'll come back to that in a second. And that is for both scenarios, because a money market locks it in regardless of where the exchange rate goes. So there is a bit of work there, and it's slightly different if you have a foreign exchange receivable, because you will be borrowing in the foreign currency, not depositing as we are. Our last one then is our working three, and this is the option. So remember, the option, you have flexibility. So let's see what we have here. We have traded call options. That means the option to buy dollars for euros. So a call option is the right to buy dollars at a particular exchange rate. And there's a premium upfront of 5% of the US dollar amount. And that's payable when the options are purchased. So if we come back then, the way I always do it is you have a choice of the spot rate or of the option rate. So the spot rates are given to us. It's 1:1 or 1.2:1. And the option rates are 1.1:1 and 1.1. So we'll just tidy those up. So we now have a choice. We can either convert at 1 or 1.1 or 1.2 or 1.1, just depending on what scenario we have. Now, for a lot of students, it may not be clear from that which one they want. So just tidy that up. So it may not be clear from here which one is the most attractive. So I always do follow it down, the choice, the spot, and the option. So at the spot we've done already, that will be 6750 or 5625. Now be careful here, don't use the present value amounts. We'll deal with that at the end, because all of this happens in 6 months' time. You only decide whether you use the option or not once the 6 months is up. So we're using the full amounts, and I'll say that's from working one. If we use the option, we can lock in 6750 divided by 1.1. So 6136 in both scenarios. So what we have to figure out then is which one is more attractive. Unlike a money market where we're locked in, we can't choose to do it or not. Here we can choose. And remember, this is important, this is a foreign exchange payable. So that means we're going to choose the lower one in each instance. So that means here we will what's called exercise the option. Here we will let it lapse. So here it makes sense to use the option rate, 1.1, because it's cheaper than using the spot rate. Here it makes sense to ignore the option because it's cheaper to use the spot rate. So the option rate is cheaper here, spot rate is cheaper in scenario 2. And always use your rule of thumb. The rule of thumb always is the scenario you're afraid of happening, which we said we're afraid that the dollar will appreciate, scenario 1, is always the scenario you will exercise the option. So think of the option as like an insurance policy. But you have to pay the premium as well then. And the premium, you're told, 5% of the dollar amount, which is $337,000 today. So that's in dollars. And in euros today, you convert to the spot rate, which is 1.0965 divided by. So it costs about 307,000 euro today. You pay that regardless of whether you use the spot rate or not, or whether you use the option or not. It's like an insurance policy. You have to pay the premium. Now be careful. What a lot of students will do is they'll add this to these figures. These figures are in 6 months' time. So these figures would only ever occur in 6 months. So we have to get the present value of both of them. Present value. So I'm going to do 6136 divided by 1.06. So I'm using simple interest. The solution, one might use compound interest, but both are acceptable. So don't be too worried about that. 5789. and then you use the 5625 divided by 1.06, which of course this one is the same as the one that was up here, because it makes sense to use the spot rate in that, and you add on your premium. The reason you're adding on the premium here is both of these are cash outflows. If this was a foreign exchange receivable, you'd be taking off the premium. So I said you just might have a small bit of a difference because of the present value. If you'd used the compound interest, just to show you an example, using compound interest would have been 5625 divided by 1.12 to the power of 0.5, i.e. to the power of half a year. That would have got you 5315, which is the similar answer to the one in the solution. Let's just make sure you're happy with where those figures are coming from. So we're going to use these ones, and you're going to add those together, 6096 and 5614. It's just a small bit of difference to solution, but nothing major. So you take those, put them in, and now you come and give your conclusion. So let's have a look here. Well, clearly the unhedged is never really a good alternative because there's too much volatility. It's dearer here. Now it might be cheaper here, but that may not happen. So it's probably going to rule out that one. And again, it wasn't an alternative in this question. We just did it for tutorial purposes. So your toss-up then is between the money market, guaranteed 6,038,000, or an option which can be a small bit higher, but about 400 grand lower. So in terms of your rationale, the option looks better. Why? Small downside risk for a big upside potential. So what we mean by that is, for a small extra cost, possibly in scenario 1, about 60 grand, you could save about 400 grand in scenario 2. So for a value for money perspective, the option looks well. But the more important point as well is, this is a contingent FX risk. The deal may not go ahead. That's an important one here to watch for these and other questions. If the deal doesn't go ahead and you enter into the money market, you are now stuck with $6.75 million in the US with no use for it. So it actually creates more problems if the deal doesn't go through. So whenever you have a contingent exposure or a conditional exposure, what you want to do is you want to choose the option, because the worst case is if the deal doesn't go ahead, the most you will lose is the premium, 300 grand. So that's why the two reasons of why the option looks better value here for this particular transaction. So that was a good coverage of money market and the option. The only one that wasn't covered there was the forward, and that is examinable as well for foreign exchange. So the last part of this question then, for 4 marks, outline 2 post-acquisition foreign exchange risks that EPL will have, and 1 approach to manage each. So again, a tabular approach. Come down here to part C. You have the FX risk and you have the approach. And this is tricky. You're getting back to the 3 types of risks you can have. The first one is there's clearly transaction risk here. But think about it, you're buying a US company who's going to be generating US revenues, but you're funding it. That's why you're told here they plan to finance the acquisition through a euro loan facility. So you're going to have dollar income, but euro liabilities. So the problem is here you have what we call transaction risk. That every time you make income in the US, you're going to have to translate that back into euros to pay for your loan. So if the dollar weakens, you're going to get less euros for the dollars. So when you have dollar income, you're now afraid that the dollar will weaken, not the dollar will strengthen. So that's a big issue here because you have a mismatch. You have to pay euro liabilities, which are generating euro income, or dollar income, should I say. So there's a mismatch there. So the approach will try to be matching. If you could get a dollar loan, then the dollar income could be used to pay the dollar repayments and have no FX risk. So if you could match the dollar income with the dollar outflows, either through getting a dollar loan or maybe buying stuff from US-based suppliers, but trying to match those cash flows and not be converting it all back and exposing you to FX risk. The other one you will have is translation exposure, translation risk. Why? Because you're now going to have a US-based subsidiary which is going to have to be translated back for group accounting purposes. Now that won't impact cash flow, but the problem is you have US-based assets, but you have Euro-based loans. So this risk is looking from a cash flow perspective. This is looking from a translation perspective. The best way to do this is borrow in dollars, because that means you will have assets and liabilities in dollars, and any FX gains and losses should be significantly hedged. So what I mean by significantly hedged, there might be a mismatch. Your assets might not exactly equal your liabilities. But the point is, if you net them off, then it's only the net position that's exposed. Because if assets gain for FX, liabilities will lose, and vice versa. So in both cases here, you will have FX risk, but it's really been driven by a mismatch in the financing currency. You should be matching the currency of the investment with the currency of the loan. So your probably recommendation in both approaches is borrow in dollars, because then you can use the dollars to pay the loan down, and you can also offset the dollar translation assets against the dollar loan translation as well. So that's transaction risk. This would be called translation risk. Okay, so that was a good question. Autumn 2019, 21 marks looking at small bit of mergers and acquisitions, and then 15 marks on foreign exchange risk.